Hey everyone, welcome to Scam versus Savings. My name is Sosi. I'm a certified liability advisor, certified mortgage planning specialist, and I'm excited to walk you through our topic today, specifically on refinances. So if you've been thinking about refinancing, if this has been something of interest for you and you're just like, I want to learn how to be able to understand this foreign language, how it gets manipulated, what do I need to avoid, and so on and so forth, you are going to love this video. And so as we go through this video, here is the secret to it. The secret to understanding a good refinance compared to a great refinance and then a terrible refinance is the break even. That is key. And to give it away, what we're going to cover today is being able to help you find the best refinance that I suggest in a downward trending interest rate market, which is a true no-cost refinance. We're going to go over examples and go over all the details so that you can have that information to make a really good decision. But to start us off and making sure we have all understanding, we are going to first of all dive into the background of refinances so you can have a really good grip on what they look like. And here's what I want to set up as our premise. The marketing institutions of refinancing, banking institutions, those who are just trying to make you get the deal in the door and close, market refinances, this is a corny illustration, I know, but they market refinances as 12 eggs. You can get a dozen eggs with this refinance. When in reality, the 12 eggs is 6 eggs in one hand that you have, and you're going to trade it for half a dozen eggs in another hand. So for the sake of not having a better illustration, you get marketed the 12 eggs, but in reality it's 6 eggs in one hand that you're transferring to 6 eggs in the other. And the way we're going to be able to identify what makes up the distinctions between these, what makes up a good, bad, or great, is going to be understanding the cost, the funding portions of them, and the points. Those are the 3 things we're going to dive into refinances today. So the first one, costs. First and foremost, let's go over interest rate differences. Here's something that people don't understand. There are 3 different types of interest rates from a major standpoint and an overarching standpoint that you can get with residential mortgages. A purchase loan or a purchase mortgage is going to have the lowest interest rate of all 3 of these in comparison. Purchase mortgage rates have lower interest rates than rate and term refinances. I'll explain what a rate and term refinance is right now in one moment. And then the rate and term refinances have lower rates than cash out refinances. So how do we know the differences between these? Well, a purchase one is obvious. It's when you use the mortgage to buy the house. A rate and term is defined by a mortgage that you're using to get the new mortgage to pay off the old mortgage. And in the midst of paying it off, because you're going to see here, there's going to be some room for error. Numbers change on refinances, even and especially when they're done correctly. And in that variance, they give you a little delta for cushion in the variance. So if your new mortgage pays off your old mortgage and you don't put in your pocket more than $2,000 or more than 1% of the loan amount, depending on which kind of loan we're going to do, it's considered a rate and term. So let's say your loan amount is $500,000 and you do a rate and term refi, meaning you're taking a new $500,000 loan and you're going to pay off your old loan, which is $498 or whatnot. As long as you are not going to get more than $5,000 back in your pocket when this transaction ends, that's considered a rate and term refi, and that means that you get the lower interest rate. If you're going to take more money or have more money in your pocket at closing than $2,000 or then the 1% of the loan amount, that's when all of a sudden you are now considered a cash out refinance. And cash out refinances by nature are always going to be higher interest rates than rate and term refinances. This is why a little secret for you. If you're looking at doing a cash out refinance, make sure you do a no cost cash out refinance, and 5 to 6 months later, do an immediate rate and term refi. Why? Because let's say rates stay exactly the same. Your rate will be lower if they didn't move, right? If they stayed flat. If you do a cash out refinance 6 months from now, your rate and term refinance will be a cheaper rate just by the very essence of cash out versus rate and term. So if you believe rates are going to go down, then your cash out refinance rate should be done 6 months before you think rates are going to be the lowest. So when you do that refi, you actually capture lowest. Some people, they go, well, I'm not going to pull the money out until I feel like rates are lowest. Well, then you missed the lowest rate. because you want to pull money out before you think rates are lowest so that on your next refi, you actually get the lowest interest rate type of refinance, the rate and term. That does get very confusing for people. So if you did not catch it, please feel free to rewind, check it out again, or DM me or send me a message from the information here in the description for more information or more examples. Let's continue to move on to just be able to make sure we understand now the details and the background of a refinance cost, whether it's rate and term, whether it's cash out. Here are the 4 components we need to understand for specifically refinances. And this is why refinances get so confusing. This is why I typically like to do refinances only for those who I've done loans for in the past, who trust me, who know me, because the way that true refinances work when you try to explain them correctly, the 4 aspects of cost get a little confusing. And because so many people manipulate these costs, like you'll see here in my example, to just make you feel like you're getting savings, there's a lot of distrust within these 4 categories. So let's make sure to break these down component by component. Number 1, old interest. So when we talk about old interest, what I want to bring to your attention is an example of a mortgage statement. I'm going to put this example of the mortgage statement right next. When you're looking at old interest, note this. A mortgage statement is typically going to show you, like for example here, that your next payment is going to be due in this example, April 1st, right? April 1st, as you know up, will say that you're paying the statement for March. And this should be March 1st. So this little example I downloaded isn't going to be the most clear, but you'll get my point here when you look at your own mortgage statement. Here's what I want to communicate. Your next month's mortgage payment is paying for the month prior. Mortgages are paid in arrears. So April's payment is paying for March's. So here's what I want to reinforce even further. When you're looking at the loan balance, the outstanding loan principal, realize that's how much money you owe. But that's not how much you're going to have to pay once this mortgage is completely paid off. Why? Because this outstanding principal is supposed to cover as well this interest that the bank is expecting. So when you're looking at costs for a new refinance, what you want to do is you want to take this interest number, which in this illustration, it's going to be about $1,048.07, and you want to multiply it by 1.5. Why 1.5? Because when you go pay off this old mortgage, the mortgage company is going to say, hey, let's say you in this example, let's say you're going to pay off the old mortgage on April 15th. Then the mortgage company is going to say, hey, you're paying off this old mortgage April 14th, but our balance was for March. So we need you to pay March's interest and the 15 days that you borrowed our money into April. That's why, for example, and just for estimates, taking your interest payment and timesing it by 1.5 is a good general safe number to estimate there. So the first position of cost is your old interest. Then number 2, your escrow impound account. What this is the money that has been set aside to pay your taxes and insurance when they're due, right? So these are not fees. These are your bills that you paid up front when you closed the loan, and you've been paying into it every month so that there is a reserve account set aside for you to pay those taxes and insurance when they come. So what you do to find this, right, after you identify the 1.5 of your interest, then what you're going to do is find your escrow balance. So here on your escrow balance, this is $1,411. So that means when we're looking at the cost for the mortgage, one part's going to be the old interest. And note, that's money you're going to pay one way or another. So that's not necessarily new costs or transactional costs. That's just old costs. Your escrow and impound account, this is money that is yours. So when you look at this escrow balance, this money is set aside money of yours. They're waiting for you. So when you pay off the old mortgage, guess what they do? They refund you this amount, usually within about 30 days. So effectively, that money, the escrow and impound money, is money you're putting up front and you're going to get back. That's that 6 eggs up front, and then you'll get half a dozen back on the other. Now we go into your transactional fees. These are actually the fees you want to be the most attentive to, because this is where mortgage manipulators are going to come in and try to screw around your savings. Let me show you an example. According to federal regulations, you have to get a loan estimate when you officially apply for a mortgage. In this loan estimate, the way you can tell what you're actually being charged is going to be more so looking at sections A, B, C, and E. When you look at these 3 sections, Those are the transactional fee sections. See, sections F and G, those are talking about your taxes and insurance, not the transactional fees of your actual new transaction. So if you're trying to figure out what are the costs of my loan, how much am I paying the mortgage company, the title company, everybody involved to even give me a new loan, that's where you add up A, B, C, and E. Now, if you're working with a good loan officer, you'll also see lender credits here in section J. But with that said, we'll go into that later. So if you're trying to figure out what are the costs of my loan, number one, what is the old interest? Number two, what is my impound account that I have to refill? Number three, what are the transactional fees in section A, B, C, or D of the loan estimate? And then number four, what are going to be the new prepaid interest that I have to pay for the new loan, right? Because just like the old mortgage is charging you from the 1st of the month to the 15th of interest because you borrow their money all the way till April 15th, the new company, your first mortgage payment's not going to be till, if we're closing a loan April 15th, your new mortgage payment's going to be June 1st. And remember, June's going to pay for January, February, March, April, May. Your June payment's going to pay for May, and April gets paid at closing. So the 15 days from the 15th till the end of the month, guess what? That's new interest on the new loan. So therefore, the new mortgage is going to charge you that. So the four areas of fees that make up a refinance is your old interest, which we already talked about how to safely calculate from an estimation standpoint, your impound account, which is your bill money set aside, your transactional fees that if you're working with a really good strategist in a decreasing rate market is thinking about offsetting all those fees with credits. And then fourth, your new interest you're paying for the new loan, which again, 3 of these 4 fees are going to be same fees you're paying, quote unquote, whether you have the old loan or the new loan. And we'll see that very clearly in the example. So next is your funding. How are you going to fund those fees, right? How does this get paid? Well, one, you can finance it into the loan. This is where it gets very misleading. So many people will show you savings, like I will here in a moment, where it seems like your payment's dropping, but your loan amount increased by thousands of dollars unnecessarily because of bad planning. 2, you could pay for this money up front, right? Any of the fees alone, all 4 of them, you could pay for them up front, and cool. You paid it out of pocket, you saved your money. Are you overpaying? We'll go into that in a moment. 3, you can take a higher interest rate. And this is how no-cost refinances get actually paid for, because we all know we've lived life long enough where we know there is no free money. There's discounted money depending on what programs, depending on what relationships you have with the lenders you work with, but there is no free money. The actual cost of the loan is being covered with typically a slightly higher rate. How high is going to be depending on what kind of deal you're getting. And then the 4th way to pay for those costs is a mix of all the above. Maybe finance them into a loan, maybe pay some upfront, maybe pay some with a higher interest rate. That's your 4th option. So first went through costs, now went through funding. The 3rd piece we're going to go through is points. When you do a refinance, you can do temporary buy down points, which means that you take a higher interest rate. You get your mortgage payment supplemented for the first 12 months or something to that degree. The second option is you pay permanent points. You actually pay for your interest rate to be lower, and you'll see that in a moment too. I do not recommend to pay points on a mortgage unless you believe you're not going to refinance again. And the key to that, will show the formula for it, is going to be in the break-even math that we'll show here in a moment. And then 3rd is going to be your hidden origination. The points of a loan is going to be temporary buy down points, permanent points, or your broker origination being hidden to make it seem like it's just origination, but effectively it's the same thing as points, just depending on how your loan officer might be doing it and what operation they work for. The worst thing about it, though, is typically it's not a write-off as much as actual interest rates are. But that's for you to confirm with your CPA. That being the case, those are the categories for points. So we went through costs, what costs are in a refinance, how do I pay, pretty much fund those costs, and then the 3rd category that gets misleading a lot is points, which I will clarify in summary. Temporary buy down points, to better explain, are monies set aside, like the reserve account earlier, to supplement your mortgage payment. So you have a lower interest rate for the first 12 months, effectively, because you have money setting aside so that it can pay your payment to make it seem like you have a lower interest rate for the first 12 months. Temporary buy down is pretty much supplemented mortgage payments. Permanent buy downs are an allotment of monies paid up front in the form of 1 percentage point, half a percentage point, 2 percentage points of the loan amount. And if you pay this money up front, the lender then goes, cool, I'll charge you less for the next 30 years, 29 years, whatever the terms are. So that being the case, temporary buy downs are paying for funds aside to supplement your payment. Permanent buy downs is literally paying the lender upfront money so they charge you less every month going forward. And then the hidden origination is just money that's getting made by the banks. With that being said, let's now go into a few details of the break even, because this is where things get missed the most. I've spoken with the smartest people out there, some of the best financial professionals in the game, in my opinion, and statistically seeing their numbers with how many clientele they serve. And I can tell you so many times people, and we've all kind of had these conversations, get surprised at it. We get blown away seeing that people think with mortgages in a very linear format. They forget mortgages are attached to an evolving animal called the real estate market and life. And so the key to know what refinance you should do is figuring out, what is my next step? Am I going to get this refinance and keep it for 30 years? And I'll share with you right now, I'm a top 1% professional in the entire country. I do more mortgages than 99% of those who actually are licensed to do mortgages. I coach, train, and educate financial advisors, CPAs, realtors all across the country. And I don't know one person who knows one person who's had a mortgage for the entire 30-year term. That's just not how it works, right? Why? Because most people refinance when rates go lower. They pull out cash when they need it. They sell their house or they move out and they now get another mortgage. So what you want to do when you're identifying what kind of refinance I should do, if you confirm that you should do one, is now identifying what is my next step. Because that next step, whether it's 3 years from now, 5 years from now, 6 years from now, that's going to be your target to then evaluate your break-even point from. So what are we talking about? How do we calculate this break-even point? Break-even point is going to be your costs, the actual cost you're paying or the credits you're getting, right? And we'll show an example of this in a moment. So let's say you're paying the $5,000 costs, and then you compare that to a payment where you're comparing your other refinance. So option A refinance, I'm paying $5,000 and I'm saving $500. Option 2 refinance, I'm taking a higher interest rate, so I'm only saving $400, but I'm not paying $5,000. So what do I do there? So if my difference of payments is $500 of savings or $400 of savings, and one comes at a $5,000 cost and one comes at a no cost, my difference of savings is $100. So $5,000 divided by $100 is going to leave me $50. So I divide that by 12, and now my break even is 4.1 years. So that means in translation, and if you didn't catch that, feel free to rewind, rewatch it. That means in translation, if I refinance or if my life event break-even point is sooner than 4.1 years, so meaning that I refinance or I pull out, I do a cash out refinance or I sell or I move out, if I do one of those four things within 4.1 years, I paid too much money for the out-of-pocket $5,000 loan. I should have taken the higher interest rate one. If I put the money up front, that means at 4.1 years, I actually start saving. That's my break-even point. So when you're identifying what kind of refinance you want to do, you want to look at what is your life event that's going to now be your indicator for your break-even milestone. So that being the case, let's get into the fun part, the example. So here is the example. Let's look at this situation where the current value of the house is $875. They have a 7.125 interest rate, and the loan balance is $667,496. Their monthly payment is $54.93.50. Here are the different types of refinances they can look at. So first and foremost, let's look at the traditional refinance. A traditional refinance, there's a value. The loan amount is going up to $668 because we're rounding up, and the interest rate is going to be a 6.375. That is fantastic. That means that we are saving $535 on a monthly basis. Your new mortgage payment is going to be $49.57, and your out-of-pocket is $16,000. Wow, 16 grand. What makes up that 16 grand? Well, that wow is also 535. So that's great. I mean, this is taking the indicators that we want to do. Is your loan amount going up drastically? 667 to 668? No. That's very good loan amount increase for your refinance. So if we're trying to analyze this and identify, is this a good loan? Check. You're good there. Is your rate decreasing to a sense that could make sense? Yeah. I mean, your rate's decreasing to a place where your payment's going to be 535 lower on a monthly basis. The next is, what are my costs for this? So when you go here, or in my example, I have a software system that I can do for you guys as well. So let me know if you want me to run one of these scenarios for you too. In my closing cost section, what you're going to be able to look at is the fee detail. In the fee detail, there's about $5,000 of estimated closing costs. Then there's a $37.22 escrow balance, and then there's a $59.50 total prepaid interest. So that means these are pretty much same fees you'd be paying, right? They're not new costs. These are just part of your old costs. This is going to be refunded as far as the $37.22, but this big old yellow $5,000, those are costs. So effectively what's happening in this scenario, like we talked about earlier, is this person is paying the cost for the loan and they're paying all their prepaids, all of it up front. So where does that leave us? That leaves us in a position where they're paying $5,000 in this $15,918. There is $5,000 of transactional fees, A, B, C, D, and E categories that they're paying with no credits to offset. So is that worth it? I don't know. Let's compare. So as we look at that, let me bring your attention to the next illustration. This is the one that's the most dangerous. Effectively, and I'm just going to highlight it to you how it might get sold to you. So Mr. and Mrs. Borrower, I'm so excited to be able to help you with this mortgage. We can offer you a 5.99% interest rate right now. Your value only has to come in at $875. Your mortgage payment is going to drop to $49.34 a month. That's $558 of savings. And look at this, Mr. or Mrs. Borrower. You will not be coming out of pocket anything. If worst case, you should get a couple $100s back in your pocket when we close. So not only will you get a couple $100s when you close, this is going to be a no money out of pocket loan. And so when we look at what you're going to do, you're going to skip 2 mortgage payments of $549, $93.50. You're going to skip 2 mortgage payments of those. And then from there, you're also going to get reimbursed your impound account, which is going to be a total of, let me go to my closing costs and my fee detail to reconfirm. Your impound account or your escrow balance is going to be a total of $37.22.50 when you close. So that means effectively, when we close this loan, Mr. and Mrs. Borrower, your mortgage payment is going to be a whopping $558 cheaper. You're going to come out of pocket with nothing. And then before your first mortgage payment, you're going to have $14,709 in your pocket. That is a fantastic savings for you. If you'd like to get this started, we need to lock this in right now. So let's run your credit, pay for your appraisal, sign your disclosures, and get this thing to underwriting before rates go up. That, my friends, if you are hearing that kind of pitch, be very cautious. Here's what I mean. Look what was missed. Yes, we have the monthly payment savings. Check. We have low out of pocket. Check. But if you notice that, the $5,000 fees are still there. Where did they go? Look at this loan amount. $692,000. Your loan amount was $667,000. $692 minus $667,496. It's going to be a $24,000 loan increase. $24,000 loan increase. But Sosi, that's the lowest rate refinance and it's the least out of pocket. It's the most expensive. Be very, very wary. Here's what I would be offering you to consider from a basic level. Again, 6 eggs in one hand, half a dozen in another. Don't let the 12 egg sales pitch fool you. If you can fund your escrow balance and your interest, that's all you should be funding, right? So it should be, when we looked at the presentation, what you should be funding is your old interest, your escrow balance, and your new interest. If you can fund those 3 things, here's what it would look like. A true no-cost refinance means at the $875, the rate's going to be an eighth higher. So instead of $535 savings, you're getting $480. So first and foremost, let's bring out our handy dandy calculator there so we can see the payment difference. So that means that $512, 71 cents a month of mortgage payment compared to $49.57.95. The monthly payment difference is $54.76 a month. So in this scenario, not in this middle one, the misleading one, but in these 2 I have highlighted yellow. In this scenario, the payment difference is $54.76 a month. And what's the out-of-pocket difference? About $5,000. Because on the option on the right, you're getting up to $5,000 of credit to pay for the $5,000 of fees that this number had in it. So look at this. Now my break even, right? If my savings is $54.76, let's go back to our formula here so that you guys can be able to catch it. In our formula, what we want to do is we want to take the costs, which in this scenario we just showed was going to be $50,000, and you want to divide it by your monthly savings difference. And so if I'm trying to choose between an okay loan, a good loan that's not overcharging me by $24,000, if I want to choose between a good loan and a great loan, meaning that I have a break even of zero and I have all the costs covered, my $5,000 cost, the difference between those two loans is going to be the $54.76. That's 91 months. I divide that by 12. It's going to take me 7.6 years. 7.6 years for me to have started saving money in option A compared to option C. The no-cost refinance, where yes, you're coming out of pocket $10,953, but keep in mind what you're getting back is going to be the $54.93.50. You're going to save two of those mortgage payments, and then you're also going to get the $37.22.50 impound account. So you're going to get $14,709 back in your pocket, and you paid $10,900 up front, and then moving forward, your payment's $480 cheaper a month. From a financial planning standpoint, option C is a true winner. From a high mortgage IQ, retirement in mind, and next refinance planning standpoint, here's one more thing I would just throw out there for you to consider as a little Easter egg or an extra. If you do the true no cost recommendation, right? If you're thinking about this and you're like, 480, I'm really used to paying $54.93. So that 480, I'm cool. I want to do something with it. I don't want to just, have that for savings. I'm already used to budgeting it out. What should I do with it, Sosi? Here's what I would recommend. If you take that 480 and you put it into an investment account, so you see here your investment payment. If you take that 480 and you add it to an investment account that's growing year after year by 8%, check this out. 5 years from now, that 480 will turn into $35,000 of liquid funds for you. And even better yet, your current mortgage in this illustration, right? Your current mortgage in this illustration is going to be paid off in 28.83 years. Here's the cool part. If you take the savings and invest it into that 8% average rate of return year over year account, in 21 and a half years, that savings account that's $35,000 in 5 years, you keep letting it grow, compound interest. That thing's going to be the same amount you owe on your mortgage 21 and a half years from now. So your mortgage payment will keep going down because you're paying the payment. Your investment account will keep going up. And in 21 and a half years, you'll have the same money in that account and as you do in the mortgage payment, with the theoretical ability to click a button and pay off your whole mortgage in that one instant. So all that to say, when you're looking at refinances, make sure you're looking at all the components that we talked about. What is my interest rate? What is my savings? What is my cost? And then if you want to up level, what am I going to do with my savings to take advantage of future opportunities to make me more money and create a better legacy for me and my family? So as you're looking through these options, feel free to let me know if you have any other questions. Thank you so much for going through this scenario with me. If you have any questions, put it in the comments. Let me know here. Send me an email. Anything I can do to help you, please let me know. And if you want me to review any of your mortgage statements and make more content out of it, send it over as well. And if you'd like, we can use that as an example to teach other people through this channel as well. And if you don't, no worries. Privacy is key. And so if you just want a personal review, happy to do that for you guys as well too. And before you go, hit subscribe, hit the like button, and we'll see you on the next video.